Every product on a store shelf started as a purchase. Before a merchandising company can make a sale, it must first acquire inventory from suppliers and record those purchases accurately. The way those purchases are tracked affects inventory balances, cost of goods sold, and ultimately the company's financial statements. In this video, we'll explore how merchandising businesses account for inventory purchases under both the periodic and perpetual inventory systems. We'll also examine how accountants record freight costs and other expenses associated with getting inventory ready for sale, so you can see how these transactions flow through the accounting records. Merchandising companies use inventory management systems to keep track of the products they buy and sell. There are two primary inventory systems, the periodic inventory system and the perpetual inventory system. Small businesses often use the periodic inventory system, and as the name suggests, inventory is counted periodically, perhaps once a year, once a month, or even more frequently. Under this system, purchases of merchandise are recorded in a purchases account, and the inventory account is updated only after a physical inventory count is performed. Now, between inventory counts, the business does not know the exact quantity of each item on hand without physically counting the inventory. If a company sells only a few products, this may not be a significant issue. However, as the number of products grows, managing inventory becomes more challenging. That is why many growing and large businesses use the perpetual inventory system. Under this system, inventory records are updated continuously with every purchase, sale, return, and adjustment. And as a result, the company can determine the quantity and cost of inventory on hand at any time. So, for example, large retailers such as Walmart use perpetual inventory systems. The moment an item is sold, the inventory quantity is automatically reduced in the system. And in many cases, suppliers of Walmart can even monitor inventory levels and replenish products when stock begins to run low. This creates a highly efficient inventory management process. From an accounting perspective, purchases of merchandise under the perpetual inventory system are recorded directly in the inventory account. Later, when a sale occurs, the cost of the merchandise sold is transferred from inventory to cost of goods sold. This ensures that inventory balances remain current throughout the accounting period. For our textbook example of maxx-out sporting goods, we'll use the periodic inventory method. Let's look at what accounts we'll be using next. When businesses purchase merchandise for resale, they may also return merchandise, receive allowances, earn purchase discounts, or pay freight charges to have goods delivered. To keep these transactions organized, accountants use several different accounts, each designed to capture a specific type of inventory-related cost or reduction. The purchases account and freight in account increase the cost of inventory acquired during the period and therefore have normal debit balances. In contrast, purchase returns and allowances and purchase discounts reduce the cost of purchases and are classified as contra expense accounts with normal credit balances. Trade discounts are handled differently. Rather than recording them in a separate account, the discount simply reduces the purchase price of the merchandise, and as a result, only the discounted amount is recorded. Together, these accounts help accountants determine the true cost of merchandise purchased during the accounting period. And ultimately, accountants incorporate these accounts into the calculation of cost of goods sold, which appears on the income statement and represents the actual cost of the inventory sold to customers. Freight and transportation charges can be a significant part of the cost of purchasing merchandise for resale. And one important question is, who pays the shipping costs, the buyer or the seller? In business, shipping responsibilities are determined by shipping terms. In international trade, these terms are known as Incoterms. And if you're interested in learning more about Incoterms, I've posted an additional video in Canvas. However, for this course, we will focus primarily on FOB terms, which are the terms used in our textbook examples. There's FOB shipping point, where you pay a separate shipping charge, and the seller typically delivers the goods to the shipping carrier. From that point forward, the buyer is responsible for the transportation cost. Under FOB shipping point, ownership and risk transferred to the buyer when the goods are shipped. The alternative is FOB destination, and under these terms, the seller is responsible for the transportation costs and retains ownership and risk while the goods are in transit. Ownership transfers only when the goods arrive at the buyer's location. If the buyer is responsible for freight costs, the buyer may either pay the transportation company directly or reimburse the seller if the seller paid the freight charges on the buyer's behalf. So let's look at an invoice and see how freight terms and other important purchase information are reflected in the source documents used by accountants. This is the invoice that maxx-out Sporting Goods received from Modern Sportsman for the purchase of men's compression shirts and shorts. At the top of the invoice, we see the name and address of the seller, Modern Sportsman, and in the upper right-hand corner is the invoice number, which uniquely identifies this transaction. The next section contains the buyer's information. In this example, the bill to and ship to addresses are the same. However, many businesses have separate accounting and warehouse locations. In those situations, the invoice is typically sent to the accounting department, while the merchandise is shipped to a store or distribution center. To the right of the buyer information, we see several important details, including the invoice date, the purchase order number, the shipping company, Speedy Express, and the payment terms of net 30 days, meaning payment is due within 30 days of the invoice date. Further down the invoice, we see additional shipping information, including the shipment date and the freight terms. Notice that the terms are listed as FOB Tustin. And since Modern Sportsman is located in Tustin, this indicates FOB shipping point. And as a result, maxx-out Sporting Goods is responsible for the freight charges. The invoice shows a quantity of 10 units, a unit price of $476, and a merchandise total of $4,760. The freight charges of $360 are added to the invoice, bringing the total amount due to $5,120. So what happens next? Before recording the invoice, the accountant performs a three-way match. This means comparing the purchase order, the receiving report, and the supplier's invoice. If all three documents agree, the invoice can be approved and recorded in the accounting system. maxx-out Sporting Goods uses the periodic inventory system, which determines how accountants record the purchase. Under the periodic inventory system, all purchases are immediately recorded as an expense, and only after the inventory determines how much inventory is in stock or on the shelves will the accountant make an adjusting entry to move some of the cost to the balance sheet. Let's analyze this purchase now. Purchases increased. Purchases are an expense, and expenses increase with debits, so we need to debit purchases. Freight-in also increased. Freight-in is an expense, and expenses increase with debit, so we debit freight-in. The invoice has net 30-day payment terms, which means that the company now has more accounts payable. Accounts payable are a liability, and liabilities increase with credits. Therefore, a credit to accounts payable. We start by writing the date into the date columns and the account purchases into the description column. The cost of the shirts and shorts is recorded in the purchases account, and the shipping charges are recorded in the freight in account. And that's why we debit the account purchases for $4,760. And on the next line, we write freight in, enter the description, and debit that account for $360. On the third line, we slightly indent and write the accounts payable account into the description column and $5,120 into the credit column since the payment terms are net 30 days. So this is the process for recording purchases for resale. Now, when you purchase other goods that the business uses, like office supplies, office equipment, or software, basically goods not for resale, the freight charges are an integral part of the purchase and not separated from the cost of the product. When the payment is due, we analyze the transaction and find that accounts payable decreased, which is a liability account, and according to the dealer mnemonic, liabilities decrease with the debits. So we need to debit accounts payable. Next, we find that cash also decreased. Cash is an asset, and assets decrease with credits. So we need to credit cash. And we're ready to record the journal entry by writing the date into the date column, and a debit to accounts payable and a credit to cash for $5,120. Here's another example of an inventory purchase for Lens Queen Shop, a retail store that sells cameras and photography supplies. On April 3rd, 2024, the business purchased camera accessories on credit from Vision Supplies with invoice A25 for $1,025, terms net 30, with a freight of $25 prepaid by Vision Supplies and added to the invoice, total amount due $1,050. In this case, purchases and freight increase. Both of these accounts are expense accounts that increase with debits. So we debit purchases for $1,025 and freight in for $25. Accounts payable also increased. Accounts payable are liabilities, and liabilities increase with credits. So we credit accounts payable for $1,050. Understanding how merchandise purchases are recorded is an important part of the accounting process. In this video, we explored the differences between periodic and perpetual inventory systems, examined common freight terms, reviewed the information contained on a supplier invoice, and learned how accountants record merchandise purchases and freight costs. Accurate recording of these transactions ensures that inventory, accounts payable, and ultimately cost of goods sold are reported correctly in the financial statements. Now, of course, not every purchase transaction goes exactly as planned. Sometimes merchandise is damaged, defective, or does not meet expectations. In the next video, we'll examine purchase returns and allowances and learn how accountants record those transactions when inventory is returned to a supplier or a price adjustment is granted.